The business of culture, the culture of business, policy, media and technology, markets, creatives, so much more. Full disclosure, I'm Robin Farzad.
People become convinced that, 7% inflation isn't just a one-year thing, that it's going to be like this year in, year out. That makes it much harder to get prices back down to the rates of inflation the Fed would prefer to see. And so the reason they're thinking about 4 or 5, maybe more interest rate hikes this year is to try to nip that process in the bud.
How high will interest rates go? This multi-trillion-dollar question is dominating markets as inflation boils and the Fed enters the delicate job of hiking rates out of the pandemic. What about the wild cards of the global savings glut and Wall Street's lack of an institutional memory about high interest rates? Stay tuned. This episode is made possible by the support of Salomon & Ludwin, a boutique wealth management firm dedicated to helping families make smart financial decisions. You worked hard and sacrificed to create and build wealth. They treat advice given to you with the respect your journey deserves. For over 30 years, Salomon & Ludwin has earned a reputation of trust and confidence, recognized by Barron's as a Hall of Fame advisor. More at salomonludwin.com. Full Disclosure Podcast to NPR.org, NPR One, Spotify, and Apple at linkfulldradio.com. Please subscribe, rate, and recommend us. A shout out to our radio partners, WVTF, Virginia Public Radio, WERA in Northern Virginia and Washington, D.C., WPVM in Asheville, North Carolina, and KPPQ out in Ventura, California. Holler if you too would like us on your air. Joining me from Washington, D.C. is Ryan Avent, Trade and International Economics Editor at The Economist. The cover is How High Will Interest Rates Go? How are you, sir?
I'm doing very well. How are you?
Well, how high will interest rates go? This is an existential issue that has kept me up for much of this century. In reading this feature, I'm thinking to myself, are we going to be looking back at this time when the Fed seemingly every couple of years has to go into emergency interest rate policy and look back and say, gosh, that was not normal. There's inevitably a bill to pay.
Well, it's a really good question. As you say, it's a really important question. I think the answer depends on how long into the future you're looking. And so, if we just think about the next year or two,
sure.
We've got an inflation issue in the United States, but also all over the world that is rooted in, the big pandemic relief policies that governments enacted, and then supply chain disruptions and things like that. As the Fed tries to fight that inflation, interest rates are going to go up. They may go up higher than we've seen in several decades. But then when you think about the slightly longer time horizons, 3, 4, 5, 10 years down the road, I'm not so certain that we've actually left behind the old pre-pandemic normal where rates seem to just bump along close to zero forever.
I want to quote from your essay, interest rate rises are daunting because much of the world has got used to an era of almost free money. No G7 central bank has set interest rates above 2.5% in over a decade. Back in 1990, by comparison, all of them were above 5%. Cheap financing has come to seem like an indelible feature of rich economies. It has let governments run extraordinary deficits, propelled asset prices to astronomical highs, and forced policymakers to reach for other tools such as bond buying and stimulus checks to prop up the economy during slowdowns. I think about the Federal Reserve as far more complex and intricate and powerful than it was upon creation more than 100 years ago. Why does the central tool remain so kind of blunt and dumb that it could take interest rates to zero, it could buy tens of billions of bonds every month, send asset prices soaring, and a side effect of that is inflation, but it's not necessarily going to cause people to hire or for wages to go up. It disproportionately, to my mind, in my experience, helps stock and real estate and risk asset holders.
Well, they have so many different things that they have to take into account. The mandate that they get from Congress is in itself kind of a contradictory one, that they're supposed to both achieve stable prices, low inflation, but also maximum employment. And so, over the generations, economists have argued, how do we best do this with monetary policy? And the sort of lodestar for not just the Fed, but most central banks is an inflation target around 2%. And the question is, how do they achieve that? what they try to do is adjust interest rates. But when you are in a really low interest rate environment and interest rates fall all the way to near zero, then you're kind of stuck because you can't really push rates far into negative territory. And so that's when the bond buying comes in. And you're right, like a big effect of monetary easing is often to push up asset prices. That's part of what happens.
Why does it seem like that's the main effect of monetary easing? I mean, I'm not in the trenches. I'm not doing kind of bank-to-bank lending or anything, but I've now seen this in 2001 and 2002, and Greenspan kept rates unnaturally low for too long, and people argued that swelled the subprime bubble. And then what happened in 2007 and 2008, and the Fed had to go to zero, and there was quantitative easing and other extraordinary measures. And then we have this kind of exogenous crash and this cataclysm in the pandemic. Well, what do you know? Within a matter of weeks, the Fed goes to zero, and we see not that it's necessarily one-to-one or caused purely by that, but asset prices and risk-taking and risk profligacy in the 2 years following that, far more than wages or core economic activity.
Well, I think it's a reflection of the kinds of tools that the Fed has and the kinds of tools it doesn't have. So I think if the Fed could do whatever it wanted, then when the economy started to grow more slowly, what it would probably choose to do is wire money to just households to kind of do what the government does when it sends out stimulus checks, that sort of thing. Because what you're trying to do is generate more spending, so there's more job creation, more hiring, so on. But they don't have that ability. They're not allowed to just send us all money, sadly. And so all they can do is change the credit conditions that are facing markets and hope that ends up working its way through the system, so that if you're a business, your stock price is higher, you're able to have access to cheap capital, then maybe you invest. And as you invest, you end up hiring more people. Now, in practice, what we've seen a lot over the past 2 years is that companies don't do this so much, that they, buy back stock or they raise their dividends or things of that nature. There's just only so much the Fed can do about that. It has to do the best it can with the tools it has. And that's how we end up in this situation, kind of hoping that high stock prices end up in some way translating into better conditions for everybody.
Isn't that kind of faith-based economics? I don't understand. I mean, even what the Fed did this time with asset purchases, it shattered a handful of taboos that we didn't have with, say, the Fed of 20 years ago. I mean, you used to be able to just buy government bonds and mortgage securities, right? And now they did more than that.
They absolutely did. They did quite a lot more than they'd done in ages after the global financial crisis. And then when the pandemic struck, they broadened those programs even more. But they did it for a good reason. So if you are a major corporation and in order to sort of pay your bills each month, you kind of go out to the market and you're routinely borrowing sums of money over the short term, then if that short-term funding suddenly dries up because everyone's scared to death about a pandemic, you're in trouble. You can't send out, paychecks to workers. You can't buy the components you need to produce whatever you're producing.
Sure.
So they're trying to prevent those markets from breaking down so that normal economic activity can continue. What's interesting, though, I think, is that if we look at how the recovery from the pandemic was different from the recovery from the global financial crisis, what we see, it was a lot faster and more robust. And also there was a lot more inflation. And I think that's because the Fed got such a helping hand from fiscal stimulus, from the government sending checks to people, making unemployment benefits more generous, all those sorts of things. And so it was a more balanced approach in this way. And it's partly because of that more balanced approach that growth has been so much stronger and inflation has been so much higher than we've been used to.
Full disclosure, I'm Robin Farzad. You're listening to Ryan Avent. He's trade and international economics editor at the Economist magazine. The cover story is how high will interest rates go? It's this multi-trillion dollar question. In fact, you cite in your essay, the world's debts have reached 355% of GDP, making firms and households more sensitive to even small rate rises. There are a few examples of central banks taming inflation without the economy suffering recession. The last time America's inflation fell from over 5% without a downturn was over 70 years ago. Fighting inflation could put the world in a slump. Which has me thinking, Ryan, about institutional memories. When I talk to credit people and Wall Street bond traders, they lament that there's really nobody on these desks, nobody that remembers kind of the Volcker period and the pain trades of the late 70s and early 80s and true inflation and high interest rates and, I don't know, these fabled bond vigilantes and the like. It's all stuff that we read in economics textbooks, but no one, because the Fed has been so successful in breaking the back of inflation over 40 years, nobody truly remembers what capital I inflation is like to tame institutionally.
Well, I think you're definitely right that there is part of the shock that we're experiencing now is people just, there are people who've been working on Wall Street for a long time who've never seen, inflation rates that are this high or interest rates that were sort of sustainably above 5%. But I don't know, I think it goes both ways a little bit too, in the sense that, the world is different now than it was in the 1970s. I think some people who have memories of the 1970s are kind of too eager to see the world through that lens, when actually we're in a different place. The world's much more globalized. Financial markets are much more globalized. And as the stories that we put together for last week's issue point out, the saving behavior is so much different. There's so much more money sloshing around, and that's part of what creates this low interest rate dynamic that just wasn't the case half a century ago.
Well, tell me about the relationship between global savings and this savings glut and interest rates. It seems to be something that people don't think about. Mom and pop might think that inflation and the Fed disproportionately control where interest rates are headed. But then again, Ryan, we had our bond rating downgraded back in 2011 by Standard & Poor's, and the debt load has only kind of gotten bigger and multiplied, and it seems like there's kind of this endless stream of people out there that need bonds, retirees and savers, whether they're Chinese or Brazilian or baby boomers retiring that want fixed income, that are willing to accept lower and lower yields. There's just this voracious demand side equation.
Well, that's absolutely right. And I think that's the bit that people don't necessarily understand when they're, considering what the Fed is doing. In the economy, there are always some people who want to save money, because they're preparing for retirement or they're going to have their kids' college that they have to pay for, a variety of reasons. And then there are people who want to borrow, either to buy a house or because they're looking to start a business or something like that. And, interest rates move around to try to match borrowers with lenders, with savers. So, if interest rates are too high, you have too many people who want to save, too few people who want to borrow, and the result is an economy that ends up in a slump. So I think if we're looking at why interest rates have sort of trended down over this very long period all around the world, what that represents is there are many more people looking to save, not just people, companies, in some cases governments, looking to save, and fewer people looking to borrow and invest. And so as markets have tried to clear that market and try to make that match there and get more people willing to borrow to soak up those available savings, interest rates have gone down. And so, it's the sort of fundamental reasons why interest rates have gotten lower have to do with things like populations getting older and needing to do much more saving for retirement, or things like inequality, where more money is in the hands of richer households. Richer households tend to save more of their income than households that don't earn as much. And so these kinds of trends mean that there's more and more money piling up in retirement accounts and pension funds and investment accounts. And, the more demand there is for bonds, the lower the rate those bonds have to pay to attract investment. So that's kind of the backstory.
And isn't it kind of by design? You try to smoke people. If you're the Fed, even though you're not going to write this anywhere, you're trying to smoke them out of the safety of savings and bonds. So, maybe they go in treasuries. So they go and they take risks and they hire people and there's capital formation. And indeed, you write in the package, since 2000 alone, the value of global wealth held by households, firms, and governments has roughly tripled from $160 trillion to $510 trillion, or from about 460% of global GDP to 610%, according to the McKinsey Global Institute. Many of them have borrowed from each other to acquire assets, taking debts to worryingly high levels. And you see these other interesting side effects happen. I mean, I don't want to take you into a cul-de-sac, but these recording artists selling their record label contracts and the like, because when you have investment bankers out there eager to make a fixed income like product, with something that lasts into perpetuity or offers a yield that's north of whatever kind of the piddling treasury equivalent is, you see kind of financial quote unquote innovation.
No, absolutely. And you're not, I don't think you're going down a cul-de-sac at all to kind of talk about those other asset classes. That's people have a lot of money they're looking to kind of store in places where they think they can get a return. That money is finding its way into, it's found its way into all the sort of traditional categories for investment and push down the returns that people earn on those things. So then you have people coming along and saying, can we create other asset classes that'll attract money? But you're right, that's not really what the Fed wants to happen. What the Fed wants to happen is for people who are happy with their money sitting in government bonds to say, these bonds aren't earning us enough of a return, so what we're going to go do is start a new company. We're going to go add to the productive capacity of the economy in some way by borrowing money and building a new factory. And I think one of the sort of frustrating things for policymakers over the past 3 decades is that interest rate policy hasn't pushed us in that direction, really. It's mostly just had people looking for new ways to kind of invest in the next asset class, even though that doesn't necessarily add to what the economy is capable of producing.
Full disclosure, listening to Ryan Avent. He's trade and international economics editor at The Economist, where the cover story we're discussing is how high will interest rates go? Clearly, everybody's talking about record stock markets, record real estate prices, crypto assets, NFTs left and right, but you're also seeing headline inflation at 7%. What is the true worrisome inflation that's not fleeting or ephemeral? It's when you see this echo chamber effect of, oh boy, I need to get a raise. You demand a raise, prices go up, people see prices go up, they go and they demand raises, and you get a vicious spiral. Is that what the Fed is chiefly looking to snuff out right now?
That's right. I mean, the thing that you worry about is that everyone comes to expect higher inflation. And so they're less bothered when prices go up by 5%. They're like, well, we'll just pay it. We're going to get it back in pay increases anyway. And these things start to feed on themselves. And, if you look back in the 1970s, there were a lot of things about how the economy worked that kind of encouraged this kind of inflation feeding on itself cycle. So you had unions that were more powerful, and they had wage contracts that were linked to inflation. So inflation went up, the wage contracts with big unions automatically went up, and that kind of really had this accelerator effect on inflation, translating back into faster prices and faster wages. The world's a little different now. We don't have as many of those natural accelerator things, but if people become convinced that 7% inflation isn't just a 1-year thing, that it's going to be like this year in, year out, that makes it much harder to get prices back down to the rates of inflation the Fed would prefer to see. And so the reason they're thinking about 4 or 5, maybe more interest rate hikes this year is to try to nip that process in the bud. The risk there is that they're a little bit overzealous about it, that maybe they overestimate the extent to which these things are starting to feed on themselves. And instead, what they end up doing is inducing a recession.
Yeah, and this is what I don't understand. You kind of argue, some people out there in following this, that when you see a jobs report, the likes that we did in the Biden administration oversaw 6.5 million jobs created and unemployment is at 4%, you want an environment that is tolerant of rate increases because you want to have, and I don't mean to mix metaphors here, you want to have arrows in the quiver in case the economy is thrown into recession so you can stimulate again, i.e. bring down interest rates?
Well, that's right. Yeah, I mean, it is good in general if you're heading into a weaker economy for the Fed to be able to do a lot of interest rate cutting. That's kind of like the Fed putting its foot down on the accelerator. And when rates are stuck near zero and then you're going into a recession, it's like there's no more room to push the accelerator, so you're in real trouble. But it doesn't follow that what we want to do is jack up rates really high now, so there's more room to cut them later. What you need is for the economy to kind of be so strong on its own, for desired investment to be so strong on its own, that pushes up interest rates, and that the Fed is able to kind of allow interest rates to rise without cutting off economic growth, so that then when the rainy day comes, they're better prepared.
Ryan, I've always mulled this question with sources and with family members and with graybeards and greenhorns alike. But when were things last normal from a monetary policy perspective, where we didn't have war or exogenous shock or Saddam invading Kuwait, rates taken to zero, rates taken to 15%. What can we look back at as saying is kind of an equilibrium benchmark for a Fed at neutral and the economy at kind of its organic staying power outside of too much or too little stimulus from the central bank? Do you see where I'm getting at?
I do. I mean, I think people would probably point to the 1990s as the closest thing to what you might think is a good normal. At that point, you had strong economic growth, but not so strong that it was triggering a big surge in inflation. You had a central bank that felt like it had the economy under control. It's funny to think back about how people talked about Greenspan in the 1990s, that he was this sort of godlike figure who could make the economy do exactly what he wanted. And part of the backdrop to that was that, you had a U.S. economy that was enjoying this productivity boom that was based on a lot of investment, like productive investment in building out the internet and things like that. And I think one of the reasons we haven't been able to replicate that experience is because there hasn't been as much of that. There hasn't been as much of companies going out and building a lot of plant and equipment and new infrastructure to make the economy much stronger. In the 2010s, investment was the lowest it's been in the post-war period. And that just makes it much harder on the Fed to try to keep things under control, prevent it from going too far in either direction.
Some people do take me to the cautionary story of the spring of 1994, when the Greenspan Fed had to pull off an emergency rate hike from 3.5%. I mean, unthinkable, 3.5%, to 3.75%. After rates were already being hiked throughout the year by a quarter point each time. Then after this emergency hike, the Fed had to take up rates by 0.5 point, and then another 0.5 point, and then a 0.75% increase to 5.5%. There are people on Wall Street who say that, firms were failing and people were in kind of disarray. You see it as kind of a blip on the long-term interest rate chart and whatnot, but there was a tremendous amount of bloodshed before obviously things picked up and the internet and the dot-com boom of the 90s took us to new highs.
No, you're definitely right. That period was one in which the 90s economy almost, was sort of strangled in its bed. That was sort of the backdrop for the Democrats' losses in the midterms in 1994. And it's an interesting thing to look back on. It's also something where the Fed actually did manage to tighten without tipping the economy into recession. And so in some ways, I think, the central bank would.
But there were bank failures. There were hedge fund failures. There were failures. I mean, people were blindsided as much as the Fed tried to telegraph. It's kind of unthinkable to imagine a 0.5 point rate hike right now, but some people are whispering about it.
They are. And I think it's, one thing that we've seen shift over the last 20 years is the communication strategy that central banks have. And in the 90s, it was a point of pride for Greenspan, really, if people didn't understand what he was going to do or why he was going to do it.
Right.
Whereas now, central bankers try to communicate very clearly everything they're going to do well in advance and why they're going to do it. And I think that in general is kind of more what you want to see. But one consequence of that is that it makes markets much, much more sensitive, I think, to any whisper of a shift in policy that's unexpected. And so in a way, we've sort of made ourselves, we've gotten ourselves in a situation where there's a little bit more fragility surrounding Fed policy announcements that just wasn't there 20 years ago. And so you might say that the Fed is able to do a lot more just by sort of slightly altering its communications than it could in the past.
I mean, they were measuring Alan Greenspan's briefcase size on CNBC. There was a whole sport about it, like deconstructing his gnomic speak that he put in three adverbs. There was a certain burlesque to it, which, made it interesting. I was working on a trading desk when during the LTCM and Russia collapse, they came in and did these massive rate cuts and saved the stock market and the economy. And now it seems like everything is so premeditated. Even so, Ryan, you have not a lot of agreement over how many rate hikes we can expect this year.
Yeah. Well, I think part of the reason there is less consensus about that is it's less because of the communication that the Fed has offered and more because of just a fundamental uncertainty over what's going to happen with the economy. We really are in very unusual territory. We have these continuing supply chain disruptions. We really don't know how long those are going to last, when they're going to dissipate. You have a lot of people who left the labor force during the pandemic, and there's a lot of uncertainty about when or whether they might come back. There's a lot of uncertainty about energy prices, which have gone up a lot over the winter. And, if Russia were to invade Ukraine, they could go up a ton more. And so I think the uncertainty we're seeing about the path of policy is much more about the world being a really uncertain place now and less about the Fed not being as clear as it would like to be about what it's trying to do.
We are talking to Ryan Avent, trade and international economics editor at The Economist. Full disclosure, I am Robin Farzad. Please stay with us. Full Disclosure podcast to NPR, NPR One, Spotify, and of course, Apple Podcasts at link fulldradio.com. Please subscribe, rate us, and recommend the show to your friends and family. Additionally, you can follow us on Twitter, Facebook, LinkedIn, MySpace, Friendster, whatever you like, at handle Full D Radio. If you're just joining us, we're talking to Ryan Avent. He's trade and international economics editor at The Economist. We're discussing the cover story that's out, How High Will Interest Rates Go? It's a question on everyone's minds. Let me ask you this. There is a more than a silver lining to this cover package here. You're wondering, well, if the world is saying we have this glut of savings and we're kind of buffering you from runaway inflation, you might as well go and invest it as central banks and policymakers to constructive purposes, i.e., you mentioned clean tech and clean energy. And these are technologies that are truly transformational, such as the internet that can engender further productivity gains. They can be broadly deflationary for the broad economy if you're able to harvest, not having to depend on petroleum and fossil fuels. Break that out for us.
Well, so I think you're absolutely right. You have a lot of people, a lot of households, a lot of firms that are trying to save, that are looking for places to put their money, that are eager to buy government bonds, even though, Treasury bonds only have a yield of 1.9% or so. And so is there anything positive to come out of the situation? Well, yeah, I think if the government were to borrow in ways that made the economy more resilient, increase the productive capacity of the economy over the long run by, investing in clean tech and building out power grids, improving infrastructure, all these things, then you're providing savers with more safe government bonds to hold their money in. And at the same time, you're, taking advantage of these low rates to make the economy better off. And I think that, that is in broad strokes what we would like to see happen. I think we've run into a problem because we tried to shove a bit too much spending through the bottlenecks created by supply chain disruptions, by the pandemic, and so on. And that's yielded an inflation problem. And I think I'm a little worried that actually that's going to convince some people that that fundamental story where it's smart to borrow when rates are low to make investments in your long run strength of your economy. I'm worried that people are going to think that's not a good idea now because we had this inflation problem. But the point of the piece that we've sort of written is that these savings aren't going to go away, most likely. And so there's going to continue to be that pool of money there that's available to finance a lot of useful stuff. And we shouldn't allow, these short run inflation troubles to discourage us and think that we can't actually afford, making these sorts of investments.
Ryan, a 10-year Treasury is currently yielding somewhere just under 2%, and you're seeing less, yields on kind of a 5-year or 2-year shorter dated securities. But then I see parallel to your cover package, the Wall Street Journal runs a feature on the Series I savings bonds from the Treasury, which have protection against inflation. There's a certain limit to what you can buy as a household, but they currently yield, quote, a juicy 7.12%. Why can't Uncle Sam meet me in the middle, right? You have objectives, infrastructure, all of these great things. You have the lack of bond vigilantes. People are just dying for yield. Why can't you give them feel good yield, right? If there's a power to offer you inflation protected yields, is it because you can't get more than 50 votes in the Senate? I mean, break this out for me. It should be easier to invest. I mean, beyond Build Back Better, to develop the grid, to induce solar, help the likes of West Virginia become whole after coal, right? All of these different things on the wish list if we're in this rarefied period where you can spend and to bank dividends over the long run.
Well, I think, there's sort of two stories there. One is can we give people 7.5% on their savings accounts? I think that's a difficult thing. You need an economy that's in a fundamentally different place, that's growing a lot faster to
But the government is offering me 7.12% on savings, $10,000 a household, right? If you were to offer some different tranche, and again, I'm taking you in a whimsical territory, but specifically, you're saying that there's a disconnect right now. All of this restive cash on the sidelines, and it's been having perverse effects with overstock buybacks or wealthy families transferring money to other wealthy families. Why couldn't it be induced to be put to more productive kind of government use?
Well, I think you have to look at the political process and what we're capable of doing politically. It's great that we got an infrastructure bill passed with some bipartisan support. That's wonderful. It's overdue. But in terms of what that's going to do to the deficit, it's actually pretty minimal. A lot of that is paid for through various offsets, and also it's kind of a relatively short window. We're just not looking at kind of a sustained massive effort to, say, build out a national high-speed rail network or to completely replace, fossil fuel energy sources with green energy sources. That would soak up a lot of capital doing that. That's the kind of thing that would A, get us on track to meet our climate goals, and B, really put savings to work. But that's not what we're seeing. And we're not seeing that, partly because the government can't get the votes it needs to do really, really aggressive spending, partly because the government can't get the votes it needs to set the rules that would encourage private firms to do that kind of aggressive spending, by putting a price on carbon, something like that. So I think in large part it is a problem in Washington. Now, if you were to look back 50 years, it wasn't necessarily just the case that Washington was functioning a lot better.
Right.
But we were in a different place where population was a lot younger. It was growing a lot faster. And so, private firms were already more willing to make investments, and there was a lot less in the way of savings that needed to be put to work to keep the economy from slumping. So, we're in a different place in terms of the desired saving and the growth rate of the economy. And to sort of get the same sort of fast growth and higher interest rates that we saw a half century ago, we thus need Washington to work way better than it did in the past. And that's obviously not where we are.
Ryan, reading this great package in The Economist, the cover package, How High Will Interest Rates Go? And the mention of decarbonization and climate, and what I mentioned earlier with record labels and veteran artists selling off their libraries, don't you suspect that true rational carbon pricing and decarbonization is going to lead to kind of a bevy of fixed income-like instruments that can kind of sop up some of the savings? Again, I know I'm taking you into some bit of the weeds, but we're talking about a true chance for, if everybody out there, every financial services firm is talking about this massive intergenerational transfer of wealth. I mean, people are looking for better alternatives. You see people that like to load up on high dividend stock portfolios as an alternative to bond portfolios. If you get into something that's creative and it's not kind of snake oily like collateralized debt obligations, maybe you can offer some kind of great supply and get the infrastructural bang as well in terms of decarbonization.
I think, you're right in terms of the big picture, but it ends up being harder to kind of push us there than you might think. And part of the reason is that, when you think about what private companies are doing, there's a huge amount of uncertainty regarding what energy costs are going to be in the future, whether or not governments are actually going to take steps to sort of set a carbon price or to require certain amounts of renewable energy to be produced as part of the national mix. There's a lot of uncertainty there. There's less uncertainty involved with kind of carving out a little niche somewhere in the media world, securing the rights to something that can't be duplicated, and selling that. So you've seen a ton of money pouring into big tech companies, tech valuations shooting through the roof. Those are companies that have kind of proven earnings models that have a lot of protection against competitive pressures from other firms, and that's where the money's flowing. If we had those sorts of risk reward trade-offs available in the energy sector now, and I think with the right policy, we could have that kind of risk reward trade-off. Then you would see much more investment in that direction. But there are a lot of reasons why we don't see that. People don't want their energy bills to go up. Fossil fuel interests still have a lot of weight in Washington. There are concerns about if the U.S. passes tough climate policy and its competitors abroad don't, what happens to U.S. industry? There are reasons why we don't have the things that we want to see. But that is why we're not necessarily seeing the investment boom we'd like to.
You were listening to Ryan Avent. He is trade and international economics editor at The Economist. We were discussing the cover package, How High Will Interest Rates Go? Sir, I really appreciate it. You're always welcome to join us.
Well, thank you so much. It's been a pleasure.
Full disclosure, stay with us. Full Disclosure Podcast to NPR One, Spotify, and of course, Apple Podcasts at link fulldradio.com. Please subscribe, rate us, and recommend the show to friends and family. We are on Instagram, Facebook, LinkedIn, Twitter at handle Full D Radio. You can catch us on our radio partners, Radio IQ, WVTF, Virginia Public Radio. We are on WERA 96.7 in Arlington, Virginia. You can catch us down in Asheville, North Carolina on WPVM, and out west in Ventura, California on KPPQ. Holler if you too would like us on your air. If you are just tuning in, we're talking about interest rates. How high will they go? Can they go after this unprecedented monetary and fiscal stimulus coming out of the COVID calamity? My guest now is Chip Hughey. He's Managing Director, Fixed Income at Truist Advisory Services, which is run by one of the nation's largest banks, Truist, product of the merger of BB&T and SunTrust. How are you? Welcome to Full Disclosure.
Thank you, Robin. Great to be here. Appreciate it.
You know, I discussed with The Economist institutional memory. You know, you're a young guy who's worked in fixed income much of your professional adult life. But these stories we hear about bond vigilantes and inflation and everything are largely the province of the late 70s and early 80s. So who the heck knows from experience, from battle wounds, from battle scars, what, you know, a spiking interest rate environment is like anyway?
That's a great point. I think that's a fair point. If I go back and look over my 17 years of experience, you know, the highest 10-year U.S. Treasury yield in my career is about 5.3%, and that was all the way back in 2007. And you know, that's a level that's a fraction of the levels that we saw in the period you're talking about, you know, the late 1970s, really through most of the 1990s. So the short answer to your question is a diminishing number of participants are familiar with the type of environment that we currently find ourselves.
What is, you know, I ask a lot of guests this, what is capital I inflation? We've certainly seen hints of it before. There was the Federal Reserve's taper tantrum in, 2013, coming out of the record stimulus of the financial crisis, record for back then. And people were worried that rates would shoot ever higher and that there was a market sell-off and a bond sell-off. But all that was short-lived as everybody still, you know, came back into bonds, plowed back into them.
Yeah, I think that's a really interesting part, you know, a big distinction with what we have today relative to, say, just back in the previous cycle. I think that if you're going to do as much apples to apples as you can, because current situation is certainly unprecedented in so many ways. But if you go back to, you know, December of 2015, when the Fed was just about to lift rates for the first time since the financial crisis, and you kind of line up the economic indicators at that time, we were dealing with a very different animal. So just by comparison, you've got GDP growth. This is on a quarterly basis, but annualized. Back at liftoff in 15, it was 0.6%. Right, that was the fourth quarter of 2015. Today, it's 6.9%. You know, if you compare, say, core CPI inflation, right, you're looking at something in the low 2% range, 2.1%. Today, it's 5.5%. And if you take, say, you know, the 10-year level itself, you're already at 2.2% at this point. And today, it's you're still below that 1.9%, but we've only
Well, here's a question, Chip. It begs the question why the Fed is at maximum easing interest rate policy this late into the game. I mean, one of the knocks on them is that they've stayed too cheap for too long, and that something Alan Greenspan had to play catch up with the housing bubble. You know, Ben Bernanke trying to put the era of 2007 to 2009 easing to rest. You know, the possible side effects and the spillovers and the flammability are terrifying. And you ask the Fed, and the Fed would say, well, it's not in our job to target bubbles. I've had the Federal Reserve president of Richmond on, the several presidents of Richmond going back, Al Broadus, Jeffrey Lacker, the most recent president, and they said it's just not within their target. They look at employment and inflation, and you can't have us targeting asset bubbles.
Right. I think one of the key differences here is a couple of things. One, the idea that inflation would cool down far quicker than was anticipated by the Fed. Really in early 21, mid 21 even, the idea that inflation, as supply chain issues eased, would help bring inflation back down and allow the Fed to take an even more patient approach. Because the Fed, by its own admission, knows that the policy tools at its disposal are really geared towards dealing with demand-side inflation, as opposed to supply-side inflation. So we have this idea of supply chains being significantly disrupted by labor shortages in the pandemic, and that is driving prices up for a pretty atypical reason than what you would see the Fed normally have to step up to the plate and address. So that is a key difference before. And what has exacerbated the situation is that a good portion of the spending that we have typically seen on the services side has transitioned even more so over to the goods side. So you've got robust goods demand at the same time as you've got these significant supply challenges. So the inflation that we're seeing, while very real and certainly from a statistical level historically unprecedented or extremely strong at the very least. That's a key difference in what is driving current inflationary pressures.
Chip, why does the Fed not have more surgically precise tools? I understand one of the knocks on U.S. central bank in the modern era is that it has this big blunt instrument. It could flood the land with cheap money and it could pull it away. And a lot of things, unintended things, benefit, such as, crypto assets and real estate speculation, maybe flippers in the housing market and the like. And you get a lot of the people who are the intended targets of it don't truly feel the stimulative oats of it. Why is it that, when you have such a peculiar inflation in this case, which as you describe is so supply side driven with demand shock, we can't get lumber, we can't get chicken, we can't get particle paper for napkins or substrate, that kinds of stuff, that the Fed is going to come in here and hike rates that would choke off important demand?
I think that really harkens back to really the Fed's dual mandate, right, which is to encourage full employment conditions as well as price stability over the long term. And I think in looking simplistically at the dual mandate, the tools that are currently in their toolbox, or were even previously in their toolbox, could address those things, particularly if there was an overheating in either of those two areas, because generally it would come out of more organic reasons or drivers behind that. This time, the drivers are so atypical, given that they are the byproduct of a global health crisis and then the recovery coming out of it. So the Fed has had to really think on its feet, really over the course of the past decade or so, in trying to add tools to the toolbox to address exactly what you're talking about, to be able to be a bit more nuanced than just to address its two key mandates. Although those are still the two key mandates that the Fed is focused on, we know that the Fed is certainly concerned with a broader scope of issues as well.
Chip, I want to quote from Alan Blinder's column in the Wall Street Journal. Alan Blinder was former vice chairman of the Federal Reserve. Was one of my college professors, economics professors. He writes, the Fed should raise interest rates, but gently. Tightening is obviously necessary, but getting it right calls for caution, flexibility, and humility. He said the FOMC's initial steps are clear, and they were more or less announced at the January 25th, 26th meeting. With the economy essentially at, quote, maximum employment and inflation far too high, the Fed must cease expanding its balance sheet and start raising interest rates. Those two policy changes are obvious and coming, albeit a bit late. If I go down, I say, but how high will rates go and how fast? That's where the decisions start getting tough. Fed watchers should understand that after some modest tightening, the central bank will be looking at two-sided risk. This kind of brings to mind the the impossible task that they have. Yes, you want to extinguish some of these forces that have been causing this uncomfortable 7% employment, but you don't want to plunge the economy into a recession or a deep recession.
Absolutely. And we couldn't agree more. And we do think that the Fed is probably going to take not only a slightly slower approach than the market currently expects. As of right now, the market's pricing in between 5 and 6 rate hikes in 2022. And we don't expect the Fed to be quite that aggressive. In fact, we are expecting closer to 4 hikes in 2022. And then also a more of a hybrid approach to tightening monetary policy in 2022. And that's really for several reasons. For one, I think that one sort of complication that the Fed faces that's significant is the current shape of the yield curve. So right now, between the 2-year and 10-year U.S. Treasury yields, you're looking at about a difference of 62 basis points. If you go
Hold on, you have to de-jargonize this for our listeners. All right, when we talk about a yield curve, what is that?
So a yield curve would basically be the extrapolation of U.S. Treasury yields from the very front end of the curve, you call it 30-day yields, out to 30-year yields. So, and then at each maturity in between those different maturity lengths.
So very short-term government bonds versus the longest-term government bonds and what they
That's
yield
exactly right.
along that curve.
And it's important. The 2 to 10 year is very important because it has become viewed as a pretty reliable barometer of economic health. So what you would like to see and what the Fed would like to see is a healthy distance between the amount of yield offered by a 2-year U.S. Treasury bond, right, versus a 10-year. You would like to see, obviously, a higher yield, greater compensation for the investor for holding on to that longer maturity in the 10-year. But what we have seen is that in instances where the yield curve flattens so that difference becomes less and less and less, and then it eventually inverts where the 2-year yield is actually higher than the 10-year yield, that has generally been a decent predictor of economic malaise within the next 6 to 18 months after that signal is triggered. So
is the bond curve right now telling us, is it signaling recession coming out of this rate hiking cycle?
That is not what we think it's saying. What we think it is saying is that the Fed does need to be careful and allow and task itself with preserving a healthy yield curve, because frankly, the scar tissue is very real from 2018 and 19, where during the Fed hike cycle, the yield curve did invert.
If you're just tuning in, we're talking to Chip Hughey, Managing Director of Fixed Income at Truist Advisory Services, which is run by one of the nation's biggest banks, Truist, product of the merger of BB&T and SunTrust. I want to get to some of these after effects. I mean, look, the stock market, Chip, I know it's a parallel show. It's the other side of the ledger to what you follow in fixed income. But your clients ask about it, and we've never seen this many trillion-dollar players in the stock market. I think there are 5 or 6. You see NFTs coined left and right. You've seen an unbelievable market for SPACs, risk-taking. This has spilled over into real estate, which has had a record year and a record recovery, and nobody can seem to afford a starter home. Recently, stock market valuation, PEs on kind of a cyclically adjusted level hit a nearly an all-time high. There are consequences to keeping money too cheap for too long.
Agreed, and we definitely think that it's time for the Fed to start removing accommodation. To raise interest rates is wholly appropriate at this point, and we just believe that it needs to take a slightly more cautious approach than the market is currently pricing in. So what we would expect to see is that if the initial couple 3 rate hikes continue to flatten the U.S. Treasury yield curve, the Fed would look pretty quickly to other tools in its policy toolbox, mainly by lightening its balance sheet. Now, whether that's passively by letting the maturities on its balance sheet roll off.
All right, I got to de-jargonize you again.
Okay.
The Fed has been buying tens and billions of dollars of bonds, so it would offload these bonds. I mean, it's had several arrows in its quiver, if you will. And this is kind of the whole process of them deleveraging or de-stimulating the economy. In closing, Chip, I have to ask you to shed a tear for the saver. What happens to savers throughout all of this? What if you've been on your best behavior? What if you're not in the world of bonds or stocks or everything? You just wanted a decent yield on your savings? That seems to have been a forgotten constituency amid all of this zero interest rate policy.
Well, we think that it's likely that, as we progress through 2022 and into the next year, that we'll actually see yields rise. If you look at many different metrics of current economic activity, whether you're looking at GDP, obviously inflation, consumer activity. If you look across, these number of economic variables, yields just look too low still. And we do believe that through the hybrid approach to policy normalization that we think the Fed will take on, not only have we already seen, a pretty steep move to higher yields in the front end of the curve, right, in short-dated U.S. Treasuries or government debt, we expect to see intermediate and long yields rise as well. And that would be a good thing for savers. That would allow new investments among retirees, from institutional investors, from overseas who are still dealing with extremely low yields as well. That would create significant opportunities to capture some of the highest yields that we have seen in some time. So we think that while the yield environment has been challenging for savers, the current recovery should allow opportunities to lock in more attractive returns for those type of investors.
Chip Hughey, Managing Director, Fixed Income, Truist Advisory Services. Sir, thank you for coming on, and please come back on.
Anytime. Thank you so much for the opportunity, Robin.
You're welcome. Full disclosure, special thanks to our producer, Claire Morgan at Notterly. This show podcast to NPR One, Spotify, and Apple Podcasts at link fulldradio.com. You can follow us on Twitter, Facebook, LinkedIn, Instagram at handle FullDRadio, and on all manner of radio stations, including Radio IQ, WVTF across the great Commonwealth of Virginia, WERA in Arlington and in much of D.C., WPVM in Asheville, North Carolina, and KPPQ out west in Ventura. And of course, I exhort you to holler if you too would like full disclosure on your air. I'm Robin Farzad. Thank you for listening. Back with you next week.